Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to be answering the question, what is limited downside risk? Okay, so what this means is, so there's there's four types of annuities today. There's the three main ones, which is a fixed annuity, fixed index annuity, variable annuity. There's this fourth new annuity. I don't know the longevity of these types of annuities, but they're called RILA annuities, Registered Index-Linked Annuities. And the way I describe it is, if a fixed index annuity and a variable annuity had a baby, it would be the RILA annuity. You get a little bit more upside, but you are at limited downside risk. Okay, so when you buy a fixed annuity, in the industry we call them MYGAs. Which stand for multi-year guarantee annuities. And when you buy fixed index annuities, you're eliminating downside risk, meaning you can't lose money to a stock market crash. Okay. Pinpointing on the fixed index annuity. The fixed index annuity is a type of fixed annuity that allows you to earn interest based on a stock market index without having to be in the market, right? So what the insurance companies does for you is they measure the performance of a stock market index, let's say the S&P 500, and you will earn interest based on the performance of that stock market index, and you won't be in the market. It's just determining how much or how little interest you earn each and every year, right? It's designed for folks who can't afford to lose money, but would like the idea of earning interest based on a stock market index, right? They don't have to worry about losing money. If you have a down year with the S&P 500 in this example, you just don't earn any interest that year. Your value stays the same. Your value does not decrease. And you just wait to the next year. And then if the next year it is positive, then you earn interest, okay? So with the variable annuity, it's the opposite. Like, you're actually in the market, you can lose money. You get a lot of upside out there, but you take on the risk. Well, not everybody is comfortable with the risk, but a common complaint has been with fixed index annuities that there's not enough upside. See, with fixed index annuities, the con of the product is you don't get all the upside. You get a good chunk of the upside, but you don't get all of it, right? And so the insurance companies thought they'd get clever and say, hey, well, what if we offer more upside than a fixed index annuity, but we offered some sort of limited downside risk where they could lose X amount of dollars or X percentage of their account up to a certain point, and then we kick in with the protection. So for example, if there's like a 10% buffer on the RILA annuity, you could lose up to 10%. And then once you hit that 10% ceiling, then the insurance company cuts off the ability to lose any more money, right? My opinion, if someone's looking for downside risk, you give them all downside risk, okay? With fixed index annuities, I think this is a better option, which is some fixed index annuities will allow you to purchase higher upside potential, right? So for example, let's just say if this fixed index annuity had a 50% participation rate. So whatever the S&P 500 returns, you'd get 50% of it. So if it returned 10, you'd get 5, right? And then, but a fixed index annuity says, hey, if you pay a 1% fee, we'll take you from 50% participation rate up to 85% participation rate. So in the same example of if the S&P 500 returned 10, you would get 8.5%, right? At the same token, if the S&P crashed, you don't lose any money like you would with a RILA annuity or a variable annuity. You just don't earn interest that year. And the psychology of it changes because now you're not worried more about not earning interest. You're kind of grateful that you didn't lose money like everybody else, because if the S&P 500 is doing terrible, everybody's doing terrible, right? So I think it's a gimmick. I'm not a fan of RILA annuities. I'm not a fan of limited downside risk. You either have downside risk or you don't. And I think if you are wanting more upside, go with the fixed index annuity, have 100% downside risk, and just pay for more upside. And then this way, you got that peace of mind, you got that ability to earn more interest, and you don't have to. There's no catching up from the year prior. You have a bad year in a RILA annuity, you have to play catch up, right? You lose money, you have to get to your previous high point to break even, right? Avoid that. So hope that answered your question. Didn't mean to go on a rant, but that's how I feel. If you've got any questions, leave a comment below. If you want a quote, contact us at the Annuity Expert. We offer them free, no obligation. And then we'll catch you on the next video. See ya.